Welcome back to the Risk Manager's Corner. In this episode, we're tackling reinsurance, an area that often gets mentioned, rarely understood, and almost never fully appreciated until something goes very wrong. Reinsurance is how insurers protect themselves from catastrophic loss, balance their books, and stay solvent under stress. But how does it work? What are the different types? And what risks does reinsurance itself introduce? Let's break it down. What is reinsurance? At its core, reinsurance is insurance for insurers. It allows primary insurers to transfer part of the risk they've underwritten to another insurance company, called a reinsurer. Why do they do this? Because it protects them from large individual losses, accumulated losses across a portfolio, capital stress during catastrophic events. By ceding a portion of their liabilities, insurers smooth out earnings, meet solvency requirements, and underwrite bigger risks than they could handle alone. Why reinsurance is needed? Let's say an insurer writes a portfolio of large commercial fire policies. A major blaze could trigger a $10 million claim, too large to absorb directly. Without reinsurance, paying that claim might wipe out reserves. With reinsurance, the insurer only pays up to their retention limit, and the reinsurer covers the rest. Reinsurance enables underwriting of large or volatile risks, portfolio diversification, capital relief, solvency improvement. It also offers technical expertise, especially in unfamiliar or emerging markets. Types of reinsurance. There are two main types of reinsurance contracts. 1. Proportional reinsurance, also called pro rata reinsurance. Here, the insurer and reinsurer share premiums and losses in a fixed proportion. Types include quota share. The reinsurer takes a fixed percentage of every risk, say 30% of all policies. Surplus share. The reinsurer covers amounts above the insurer's retention on large risks. In both cases, the reinsurer pays its share of claims. It also receives its share of premiums. Often includes a ceding commission to the insurer for administrative costs. Proportional reinsurance is simple, predictable, and used when the portfolio is homogeneous. Non-proportional reinsurance, also called excess of loss reinsurance. Here, the reinsurer only pays if losses exceed a certain threshold. The insurer keeps all losses up to that level, called the retention or priority. Types include per risk. Excess of loss protects against large individual losses. Per event or catastrophe. Excess of loss protects against accumulated losses from a single event, e.g., earthquake storm. Aggregate excess of loss kicks in after total losses in a period exceed a specified amount. Unlike proportional reinsurance, there's no sharing of every claim. It's designed for volatility protection, not portfolio smoothing. Choosing the right structure. The choice between proportional and non-proportional depends on the insurer's risk appetite, capital position, volatility of claims, line of business. For example, motor or home insurance might use quota share to stabilize loss ratios. Catastrophe-exposed property might rely heavily on excess of loss layers. Many insurers use layered structures, combining quota share, per risk, and catastrophe coverage to manage different parts of the risk curve. The mechanics. How reinsurance works in practice. Let's say a Kenyan insurer has a $100 million portfolio of commercial buildings. They take a 25% quota share reinsurance treaty and also buy a per-risk excess of loss cover for claims above $1 million up to $10 million. Here's how it plays out. A claim of $500,000. Split 75-25 between insurer and reinsurer under quota share. A claim of $5 million. First $1 million paid by insurer, Next, 4M, covered by reinsurer under excess of loss. A claim of $15 million. Insurer pays $1, reinsurer pays up to $10. Remaining $4 may fall on insurer again unless another layer exists. The takeaway? Structure and layering matter. Poor reinsurance design leads to retained losses when you thought you were covered. Benefits of reinsurance. Let's recap the strategic advantages reinsurance provides. Risk transfer limits downside from high claims. Capital relief reduces required capital under solvency frameworks. Earnings stability smooths profit and loss volatility. Product expansion enables insurers to underwrite new or large risks. Expertise. Global reinsurers bring modeling, pricing, and portfolio knowledge. Done right, it's a risk manager's dream. Done wrong, it's a false sense of security. Risks in reinsurance. Now for the other side, the risks introduced by reinsurance itself. 1. Counterparty risk. If the reinsurer fails to pay, the insurer bears the full loss. This is amplified in stress scenarios, like financial crises, pandemics, or regional disasters. Risk managers must track reinsurer credit ratings, diversify across multiple reinsurers, use collateralization when possible. 2. Basis risk occurs when the reinsurer's coverage doesn't match the underlying exposure. Example: you have per risk cover, but the loss is classified as a CAT event, not covered, or event definitions don't align. Always review treaty terms closely. 3. Dispute risk. Vague wordings, miscommunication, or claim definitions can lead to reinsurance disputes. In a catastrophe year, even a small disagreement can delay or block payment. Your documentation, record keeping, and notification protocols must be airtight. 4. Pricing and structuring. Risk. Buying the wrong cover or overpaying for unnecessary protection can dilute margins. Reinsurance isn't cheap. Treat it like any other risk-adjusted investment. 5. Operational risk. Delays in claims notification, incorrect bordereau submissions, or errors in premium sessions can create compliance issues or trigger denials. The reinsurance process must be embedded in operations, not an afterthought. Key considerations for risk managers. Here's what you need to be watching and asking as a risk manager overseeing reinsurance. What's our retention per risk? What are the limits per event? Who are our reinsurance counterparties, and what's their credit profile? How often do we review treaty structures? Are we monitoring accumulation risk across classes, regions, and perils? These questions define how resilient your portfolio really is. Final takeaway. Reinsurance isn't just a product. It's a core part of your risk transfer and capital management strategy. It allows insurers to take on bigger risks, survive bigger events, and maintain profitability in volatile cycles. But that only works when you know what you've bought, why you've bought it, and what happens when it's triggered. Designing reinsurance structures is part science, part negotiation, and 100% risk control. In the next episode, we'll unpack the other insurance risks beyond underwriting, from concentration and counterparty credit to catastrophe and pension exposures. Make sure you're subscribed. We're just getting into the deeper layers of insurance risk.